You are standing in a car dealership, and the salesperson slides two pieces of paper across the desk. On the left, a lease offer with a low monthly payment and a promise that you can return the car in 3 years with no hassle. On the right, a purchase offer with a higher monthly payment but the assurance that you will own the car outright after 5 or 6 years. Most people make this decision based on one question alone: which monthly payment is lower? That question, by itself, is almost useless. The real question is not what you pay each month, but what you pay per mile, per year of use, and per dollar of value retained. The math of leasing versus buying involves depreciation curves, money factors disguised as interest rates, residual value guesses, opportunity cost of capital, and the psychological value of never thinking about repairs. And when you run those numbers honestly, the answer is not that one is always better than the other. The answer is that each method punishes different behaviors and rewards different assumptions, and the only way to know which one hurts you less is to understand how the dealership is making money from you in both scenarios. To understand the real math, you have to start with a single fact that most car buyers never fully absorb. A car is not an asset. An asset is something that puts money in your pocket, like a rental property, a bond, or a business you own. A car takes money out of your pocket every single day through depreciation, fuel, insurance, maintenance, and parking. A car is a tool that consumes value to provide transportation. The financially optimal approach to transportation is to spend as little as possible for the mobility you need, whether that means buying a reliable used car with cash and driving it for 10 years, using public transit, or even biking. But most people want a newer car, a safer car, a more comfortable car, and they are willing to pay for that experience. The leasing versus buying question only matters once you have already decided to spend a significant amount of money on a relatively new vehicle. Given that decision, the math tells a clear story about how depreciation, interest, and transaction costs eat your wealth in different ways under different contracts. Let us start with buying, because it is simpler to analyze. When you buy a car, you pay a negotiated price, either in cash or with an auto loan. You then own the car, and you bear all the risks and rewards of its future value. The car will depreciate every year, typically losing about 15 to 20% of its value in the first year, 10 to 15% in the second, and then gradually less each year thereafter. After 5 years, most mainstream cars are worth between 30 and 40% of their original purchase price. That depreciation is your single largest cost of ownership, far larger than interest, fuel, or maintenance. When you buy a car with cash, you are prepaying all of that depreciation upfront. When you finance it with a loan, you are spreading the depreciation plus interest over time. Either way, the cost to you is the purchase price minus the eventual sale price, plus interest, plus operating costs. That is the simple formula for buying. Leasing is structurally different. When you lease a car, you are not buying the car. You are paying for the portion of the car's value that you consume during the lease term, plus a financing charge, plus fees. The lease contract starts with a capitalized cost, which is the negotiated price of the car, just like in a purchase. Then it subtracts the residual value, which is the leasing company's estimate of what the car will be worth at the end of the lease, typically after 2, 3, or 4 years. You pay the difference between the capitalized cost and the residual value, which is called the depreciation portion of the lease. On top of that, you pay a money factor, which is the leasing company's version of an interest rate, applied to the average of the capitalized cost and the residual value. You also pay taxes, fees, and sometimes an acquisition fee. At the end of the lease, you return the car, pay for any excess mileage or damage, and walk away with nothing. The key insight is that in both cases, you are paying for depreciation. The difference is who takes the risk that the depreciation is higher or lower than expected. When you buy, you take that risk. If the car depreciates faster than average, you lose more money when you sell. If it depreciates slower, you gain. When you lease, the leasing company takes the depreciation risk, but they charge you for taking that risk. They set the residual value conservatively, meaning they guess low, so that they are almost never surprised by the car being worth less than they thought. If the car ends up worth more than the residual, you do not get that extra value. The leasing company keeps it. If the car ends up worth less, the leasing company absorbs the loss, but that rarely happens because they set the residual low enough to protect themselves. This asymmetry means that leasing is essentially a bet against your own ability to predict the car's value. You pay a premium to offload risk, but the risk you are offloading is the risk of the car being worth less than expected, which is a risk that historically falls in favor of the car owner in most markets, not against them. Now let us put real numbers on this to see how the math works. Suppose you want a mid-sized sedan with a sticker price of $35,000. You negotiate the price down to $32,000. If you buy the car with a 5-year loan at 6% interest, with 10% down, your monthly payment is approximately $550. After 5 years, you have paid off the loan, and the car is worth approximately $12,000 if it depreciated normally. Your total cost over 5 years is the sum of your down payment and all monthly payments, minus the resale value. That comes to roughly $20,000 in total cost, plus fuel, insurance, and maintenance, which are similar in both scenarios. Now consider leasing the same car for 3 years. The leasing company sets the residual value at 60% of MSRP, roughly $21,000. Your capitalized cost is the negotiated price of $32,000. You pay the difference of $11,000 over 36 months, which is about $305 per month in depreciation. Add a money factor equivalent to a 4% interest rate, plus fees and taxes, and your monthly lease payment might be around $380 to $400 per month. After 3 years, you return the car and have nothing. The immediate observation is that the lease payment is lower than the purchase payment, $380 versus $550. That is why many people choose leasing. They see the lower monthly number and stop thinking. But the lease payment never ends. After 3 years, you must start another lease or walk away with no car. The purchase payment ends after 5 years, and then you own a car that could last another 5 to 10 years with no payment at all. And account for the fact that the buyer has a paid-off car while the lessee is perpetually making payments. The buyer finances for 5 years, pays $550 per month for 60 months, then has 1 year with no payment while driving a 5-year-old car worth about $12,000. Their total cash outlay over 6 years is the sum of their down payment and all loan payments, roughly $35,000, but they still own a car worth roughly $10,000 after 6 years. Their net cost is about $25,000 over 6 years. The lessee signs 2 3-year leases. Each lease costs approximately $400 per month for 36 months, so 2 leases cost about $28,800 in total cash outlay. At the end of 6 years, they have no car and no equity. Their net cost is $28,800. The buyer comes out ahead by nearly $4,000, and they still have a car they can continue driving at very low cost. Extend the timeline to 9 years, and the buyer's advantage grows substantially because the third lease for the lessee adds another $14,000 in payments while the buyer drives a paid-off car for 4 more years with only maintenance costs. This simple comparison seems to suggest that buying is always better than leasing. But that conclusion depends on 2 critical assumptions that are not always true. The first assumption is that you will keep the car for many years after the loan is paid off. Many people do not. They trade in their car every 3 or 4 years regardless of whether they bought or leased. If you are someone who always wants a new car every 3 years, the math changes dramatically. In that case, you are essentially always paying for the steepest part of the depreciation curve, the first 3 years, whether you lease or buy. If you buy a car and trade it in every 3 years, you pay the full depreciation hit plus interest plus the dealer's markup on both the purchase and the trade. If you lease, you also pay the depreciation hit plus the money factor, but you avoid the transaction costs of selling the car yourself or negotiating a trade-in. The second assumption is about the interest rate or money factor. Manufacturers subsidized leases sometimes offer money factors equivalent to interest rates as low as 0 to 2%, while the same manufacturer might offer purchase financing at 3 to 5%. In those cases, the lease can have a lower financing cost than a purchase loan, which narrows or even reverses the advantage of buying. You have to compare the money factor to the interest rate on a purchase loan for the same vehicle and the same credit profile. Dealers and manufacturers use leases as a way to move inventory without lowering the selling price, because a low lease payment looks attractive even if the total cost is high. Sometimes the subsidized lease is genuinely cheaper for the 3-year period than buying and selling after 3 years. You must run the numbers for the specific deal. There is also a tax consideration for people who use their car for business. If you are self-employed or have a business that requires a vehicle, lease payments are often fully deductible as an operating expense, while purchase payments are not fully deductible. Instead, you deduct depreciation and interest subject to complex rules and limits. For business users, leasing can provide a simpler and sometimes more favorable tax treatment, though you should consult a tax professional because the rules change frequently. This is one area where leasing genuinely makes sense for a specific group of people, not because the math of depreciation changes, but because the tax code treats the 2 forms of payment differently. The hidden variable in the leasing calculation is the mileage limit. Standard leases allow 10 to 15,000 miles per year. If you drive more, you pay a penalty, typically 15 to 25 cents per excess mile. If you drive less, you get no refund. A buyer faces no such constraint. If you have an unpredictable driving pattern or a long commute, leasing is risky because the excess mileage charges can easily add thousands of dollars to your cost. Conversely, if you drive very little, leasing might still be wasteful because you are paying for depreciation that is based on average mileage assumptions, but at least you are not penalized for driving less. The mileage penalty is asymmetric and punitive, and it represents a transfer of wealth from drivers who underestimate their annual miles to the leasing company. Another hidden variable is the condition penalty at lease return. When you turn in a leased car, the leasing company inspects it for excessive wear and tear. A dinged door, a stained seat, a cracked windshield, or tires below a certain tread depth can cost you hundreds or thousands of dollars. When you own a car, you decide what level of cosmetic damage is acceptable. You can drive a car with a scratched bumper for years with no financial penalty. The lease return inspection is a profit center for leasing companies. They set subjective standards and then charge for repairs at retail rates, often far above what you could pay at an independent shop. If you are not meticulous about car care, leasing will cost you more at the end. If you are very careful, you can avoid these fees, but the risk is always there. The residual value itself is another point of manipulation. The leasing company sets the residual as a percentage of MSRP, not of the price you actually pay. If you negotiate a great deal on the capitalized cost, you benefit because you pay less depreciation. But the residual is usually fixed and non-negotiable because it is set by the manufacturer's financing arm. This can work in your favor. If you negotiate aggressively, you can lower your lease payments substantially. However, many people do not realize that the residual is often inflated on certain models to make the lease payment look artificially low. The manufacturer wants to move cars, so they set a high residual, which reduces the depreciation portion of the lease payment. But a high residual means you are paying for less of the car's value during the lease. At the end of the lease, the car is likely worth less than the residual, which means the leasing company takes a loss. That loss is baked into their cost of doing business. They accept it because they make money on the financing and on the volume of cars sold through the lease channel. For you, the consumer, a high residual is good because it lowers your payment. The catch is that you cannot buy the car at the end of the lease for the residual value if the residual is higher than the market value. You would just return the car. That is fine, but you might have been better off buying the car at a lower negotiated price upfront if you plan to keep it. This brings us to the buyout option. At the end of a lease, you typically have the right to purchase the car for the residual value. If the residual was set conservatively, meaning lower than the actual market value, you can buy the car at a discount. This is called having positive equity. You can then sell the car privately for a profit or keep it at a good price. If the residual was set arbitrarily or inflated, you can just return the car and walk away. This optionality has value. You are essentially holding a call option on the car's future value. You pay for that option through the lease terms, but if the car holds its value better than expected, you can capture that gain. If it holds its value worse, you can walk away. In a purchase, you bear the full downside and capture the full upside. In a lease, you capture some of the upside through the buyout option and none of the downside because you can return the car. This asymmetry favors the lessee in markets where used car prices are strong, as they were during the pandemic when many lease returns had thousands of dollars in positive equity. In normal markets, the residual is set so that positive equity is rare. The psychological dimension of leasing is perhaps more important than the mathematical one. People who lease often feel less pain at the time of signing because the payment is lower. They then feel a smaller version of that pain every month for 3 years. The total pain over 3 years might be the same as the total pain of buying, but the distribution of that pain affects future behavior. Lower monthly payments free up cash flow for other things, but they also create a permanent cycle of payments. The buyer who endures higher payments for 5 years then enjoys years of payment-free driving has a very different psychological relationship to their car. They are more likely to keep the car longer because keeping it is free. The lessee, by contrast, is forced to make a decision every 3 years. That forced decision-making can lead to lifestyle creep. Over decades, that small difference compounds into a huge sum. The behavioral economics research on this topic is clear. Consumers systematically underestimate the total cost of leasing because they focus on the monthly payment and ignore the fact that they never stop paying. They also overestimate their ability to stay within mileage limits and avoid wear and tear charges. Dealerships know this, which is why they push leases so aggressively. A lease generates transaction fees and financing income every 3 years instead of every 6 or 7 years. The dealer makes more money from a customer who leases repeatedly than from a customer who buys once and keeps the car for a decade. The salesperson's commission structure also favors leases because they are more profitable to the dealership. The advice to never lease comes from this recognition that the deck is stacked against the consumer. But that advice is too simple. There are scenarios where leasing is mathematically superior, particularly for business users, for serial new car buyers, and for people who value the warranty and maintenance coverage that often comes with a lease, though that coverage is also available on purchased cars. The most honest answer is that for the average person who keeps a car for 5 to 7 years and drives an average number of miles, buying a reliable car with a low-interest loan or cash, and then driving it until it becomes expensive to maintain, is almost always cheaper than leasing perpetually. The savings come from avoiding the steepest depreciation years multiple times, from having years of payment-free ownership, and from avoiding the fees, mileage penalties, and condition charges that eat into lease economics. However, for the person who wants a new car every 3 years regardless of cost, leasing is often cheaper than buying and trading every 3 years because the transaction costs are lower and the residual value risk is transferred to the leasing company. The real financial mistake is not choosing lease versus buy. The real financial mistake is buying a new car every 3 years in the first place, whether you lease or purchase. That pattern of behavior is the wealth destroyer, and the lease versus buy question is just a distraction from that larger truth. The math of leasing versus buying is not a math problem with a single correct answer. It is a math problem that asks you to predict your own future behavior, how long you will keep the car, how many miles you will drive, how carefully you will treat the interior, how much you value a new car every few years, and how disciplined you are at saving the difference between a lower lease payment and a higher purchase payment. The lease is a bet that you will not keep the car long and that you value certainty over ownership. The purchase is a bet that you will keep the car long enough to benefit from payment-free years, and that you value long-term savings over lower monthly payments. Neither bet is inherently wrong. The wrong bet is the one that doesn't match your actual behavior. The most expensive car decision is not lease versus buy. It is choosing a payment structure that fights against who you really are.